Hello and welcome to the National FinTech Organization and this next installment in the series NFO's Growth Garage. Get smart and get connected. Today, we'll hear from Brian Casey of Lock Lord, Parker Beecham of Marked Ventures, and David Gritz of InsurTech NY as they explain InsurTech and discuss current trends. All attendees are in listen-only mode, but the chat feature is available at the bottom of the window for comments and questions. Please give it a try now and let everyone know what part of the world you're connecting from. And as we go along, add your questions for our panelists. This session is being recorded and will be available on demand within the next few days on the NFO's YouTube channel. And now, I'd like to hand it over to Brian Casey to get us started. Brian?
Thank you, Joey. Welcome, everyone. Let me get our PowerPoint going here. So I'm Brian Casey. I am a partner in the law firm of Lock Lord. I'm based in Atlanta and co-head our corporate and regulatory insurance practice. And I'm pleased to be joined by David and Parker. I'll let them introduce themselves here in a second. So how I got to the InsurTech field, really dating myself a little bit, is when I was a young lawyer in my late 20s, early 30s. I got on the internet.com train and started working with startups that were in the insurance space, learned how to do venture capital financing and that kind of thing. And for me, InsurTech, while much different than, and back in the .com era, we called what is now called InsurTech cyber insurance, which totally means something else, of course, today. But this has been a great renaissance for me. There are a few of us old dogs still hanging around in the InsurTech environment, and it's really fun to work with and help some of these companies get along in their business model. So with that, let me kick it over to you, David, and have you introduce yourself and a little about your company and how you got to InsurTech.
Thanks, Brian. Well, I'm really glad to be on this podcast today because I think a lot of people think InsurTech and, they think, oh, this is like the ugly duckling of FinTech. But it's really, from my perspective, the really exciting area because a lot of it has been untapped. So think about if you got a chance to get into FinTech 5 or 10 years ago, that's where InsurTech is today. So, of course, there are people like Brian that have been through it since it was just the cyber component or the early days. But I got involved starting, growing, and selling InsurTech in 2015 when kind of the term was coined, and built this community after seeing that there was still a lot of work to be done, especially in New York City, which is a very FinTech heavy city. So we built this community to really support entrepreneurs in the InsurTech space, connecting to traditional insurance carriers and brokers. And we do that through an early stage startup competition. We run 2 accelerator programs. We do 6 events a year on the East Coast, the West Coast, and in the center of the country. And we have a small fund as well.
Thank you, David. Parker, over to you.
Hi, I'm Parker Beecham, as introduced. I've been in insurance practically my whole life. My mom and dad were names at Lloyd's of London, and I would get taken over on Lloyd's trips when I was 3, 4, 5, 6 years old. And I'd ride the escalators in the Lloyd's building and was totally obsessed with everything that was going on, even if I didn't know what that was. And this was something that I wanted to do and be a part of my entire life. I read all the books that I could in junior high and high school. I started to get shipped off to insurance companies to work as an intern of sorts. And at one of those in the late 90s, at 19 years old, definitely dating myself, 1999, I was working for a small mutual company, and I don't know, we were just reading policy forms, and I was trying to get on the internet and trying to get through all the corporate prompts to get the dial-up to go through. And it just came to me. I'm like, you guys have heard of the internet, right? This is all going away in a couple of years. And here we are 23, 24 years later, still, to David's point, just kind of chipping away at some of this innovation. And it was at that moment that I just thought it was just absolute luck that I loved something already that was going to go through a tremendous amount of change and during my career. And I've worked on the distribution side of insurance a long time, like Brian, through many iterations of distributing insurance online in all 50 states in the early 2000s, kind of rode the various CAC waves. until we are today, back-ending a number of InsurTechs, et cetera, in the mid 2010s. And I exited the company that I'd worked with for a number of years called Ingard, which I'd acquired, and then didn't want to leave. I wanted to keep going, wanted to be a part of the innovation scene, helping InsurTechs with ideation, strategy, pressure testing, connections network, distribution. And I did that by rolling the proceeds from my sale and joining another investor into a venture capital company that's a year old today, called Marked, after a fire mark, for those that do know some things about insurance innovation from back in the day. I'm in Boulder, Colorado, calling in from the Middle East tonight, but I'll be back there next week. So happy to be with you all.
Great. Thanks, everybody. All right, let's dig in then. So what we want to cover, and we're happy to make this kind of conversational, obviously through the chat. So please send us any questions. We'll try to address them on the fly. What we'd like to cover generally is what is InsurTech. Can mean a lot of things to different people. We're assuming, hopefully not wrongfully, that the level of understanding and knowledge about the insurance industry is, fairly low. There's probably some folks out there, but we'll try to keep it big picture mostly. So what are the business models? What are the business problems and solutions that are being addressed through InsurTechs? How are intermediaries using it? How are insurance companies using InsurTech, and reinsurance companies, which of course hold much of the risk that is insured? The capital markets and equity funding, we'll cover a little bit of that since we got two VC guys here. And then being a lawyer, I'd like to touch on a few of the regulatory issues that we see a lot with InsurTech models. So I've got a busy slide here, but this is kind of my view of what are the drivers and or types of InsurTech companies. Many, many different types of applications. So if you think about in insurance, I come more from the company perspective, and then secondarily from the distribution perspective. From a company perspective, the basic functional areas are product development and pricing, underwriting, distribution, policyholder services, and claims, although some might say claims are part of policyholder services. So those are the kind of functional areas that you'll see InsurTechs trying to address. Wide variety of things here you can see on the screen, from autonomous vehicles, the sharing economy, blockchain, parametric insurance, use of artificial intelligence. Embedded insurance is kind of a new buzz phrase in the InsurTech world, in usage-based insurance products, primarily in the auto area, and wearable technology. So a lot of stuff here. Why don't I take a breath maybe and ask Parker if you would comment on one or more of these sub areas of InsurTech, and also help us understand what kind of things you're looking for as potential investee companies.
Yeah, sure. So I try to invest in early stage InsurTechs, and so I think at that time you're looking at the team more than anything, looking to see if you do believe that it's a real solution that causes a real problem, and that there's a sizable enough market to create a great win for the company. I think that a lot of these technologies and interest areas have kind of like graduated, or they were a thing, and then I don't want to call it a buzzword, but maybe it was a buzzword, and then we've got new buzzwords. And like Brian, you said, and I'm not calling it a buzzword, but embedded is a hot topic today. But I think of InsurTech and the use of technologies to evolve a very old space, 400 years or 2,000 years, depending upon how you do your insurance history, that's always been innovating, that's always been coming up in the world. And I believe the world's a better place because of insurance. But we're at this phase where there's a more rapid advancement of insurance. But it's not going to be a flash in the pan, in my opinion. I think that a long time from now, insurance will still be a space and it'll still be innovating. And so I'm pretty long on the space as I've always been. It's taken a long time to even get to here, where I still think that we're barely scratching the surface. If I had to look at this and pull out buzzwords, I think in the first 20 years of my career, I think that, I'd heard about parametric 2 or 3 times, and I've heard it probably 20 times in the last 6 or 8 months. So I'm not saying that that's a new thing, but embedded is very hot, where you're taking an insurance product and you're kind of inserting it into another transaction or supply chain or distribution vehicle, which makes a lot of sense. Sometimes, the thing that you're attaching insurance to is better because insurance is attached to it, and the insurance is better itself because it's attached to it, because there might be some sort of data exchange or loss control, risk management, ease of distribution, ease of settlement, that makes things much easier. So I think that kind of describes the space. I think a connectedness is still a very viable option inside insurance, where you're taking some sort of connected device, IoT, et cetera. And so where you're attaching that to an insurance product, and so you're like 1 + 1 is 4 or more. Typically, nobody wants a bad thing to happen. No insured wants a bad thing to happen. No insurance company wants a bad thing to happen, although they still need the insurance in many cases, or it's required. By connecting to something that makes the thing less likely to happen, I think makes a lot of sense. I think there's an area on here, it might be on here, big data. I don't know if that's a dirty word today, but I like to say the use of data for good is a very interesting space for me. Nothing creepy, just how do we use a great degree of intelligence to try to help improve the outcome for all parties, particularly the consumer involved. And like you said, Brian, reinsurers take a lot of the risk here. Well, there's parts of that model that aren't working today. They've had a really tough past couple of years, and I think it likely gets tougher as climate risk is on the rise, and the models might not work, and that's a cost that's going to get spread across a lot of parties, including consumers. And so I think that those are some hot areas for me. I would include artificial intelligence in that use of big data. But, I'm a huge fan of blockchain. I've not really seen any viable options or uses for that, but I do think that ultimately that's, trust is a thing that you're selling in insurance and always have. We're going to take some of your money, and we're going to promise you that we're going to give that money back to you and some, if the following things happen. And I think the use of smart contracts and ledgers make that trust protocol a lot more viable, or maybe worthy. So I don't know. I think that those are kind of the spaces that I think about, that I see on this list, that I find are exciting. And I hope I shared a little bit about which each of those things are. But tell me if I'm wrong.
Yeah, no, great. Thanks, Parker. I probably should have prefaced this too, for those of you that may not be intimately familiar with the insurance industry. So the basic segments are commercial lines and personal lines. And of course, personal lines, you've got life insurance, you've got home and auto, and you've got health. On the property casualty side for commercial, there's all kinds, surety, workers' comp, general liability. So this market the products can be segmented in many ways. You mentioned the parametric insurance, Parker. That's an interesting one. Seems to be an uptick there. So the first type of parametric product that I'm aware of, it was in the travel area, right? So your flight gets delayed or canceled, and you automatically get a fixed payment. Very simple product to implement. I'm working with a new company now that's working on parametric for tornadoes. So if you live in the zone where the F3 hits, you would get a payment, even if, in theory, even if your home did not actually incur damage. It has a little bit of regulatory issue there, but that's the concept. So that it's really just kind of a fixed benefit that gets paid if the covered event occurs. On the wearable technologies, for example, in the life insurance area, I think there's a company called Vitality, which I think is John Hancock, that underwrites life insurance at reduced rates, in theory, for folks that wear wearable technology that helps kind of constant underwriting, if you will. In the usage-based telematics area, that's auto insurance, of course. Most of the big insurance companies, Progressive and Geico and nationwide have some product for usage-based insurance, whether that's through a cell phone that's monitoring, braking patterns and hard stops and that kind of thing. You're seeing more activity of that now in the commercial trucking area. I'm working with another cool startup that comes from the neuroscience area, and they had a real success in Major League Baseball trying to profile AA players, a guy that lives in Illinois versus Texas, and their habits and characteristics and qualities, fielding and hitting balls. And they're applying that technology now in the commercial fleet area for drivers to test their readiness and monitor their performance while they're out driving trucks. So really cool applications here. David, let me kick it over to you and see if you can comment on some of these that you're seeing and those that you like.
Sure. So I think Brian and Parker did a pretty comprehensive coverage on this, and Parker's definitely on the leading edge of a couple things where I would say, he's definitely ahead of the curve. So maybe what I could share is, since with our accelerator, it's backed by carriers. So we have 10 carriers behind it that kind of pick and choose what goes into it. So I'll share, maybe 2 that are hot and 2 that are not so hot. So playing what's hot or not, first, definitely in line with Parker there with embedded insurance. And we actually did a webinar a couple weeks ago with a startup in Singapore, and they've been working with Volvo Financial Services. So not Volvo, the passenger autos, but actually Volvo, the truck companies, like they own Mack Truck. And one of the interesting concepts that came up is, a lot of embedded can be point of sale, like Parker brought up, but it can also be aftermarket, right? So you have a Mack truck, you need to get some service on it. That's an opportunity to get you into some type of insurance or warranty product. So I would say embedded is probably like the hottest of all the bubbles in this diagram. Another one that I would have to say is the number 2 for what's hot. And like Parker said, these are 2 kind of intertwined, but I would call it alternative data. So that combines big data and artificial intelligence. So carriers are always looking for getting their edge. And I was at a conference that Ernst & Young organized, and they had someone present from Convex, which is one of the Lloyd syndicates. And what they said is, since the 1960s, a major thing has changed. There used to be, winners and losers every year in underwriting, where someone would have, 70% loss ratio on a line of business, and someone would have, 90, 95. And the people that had 70 could go into the next year well flush with capital and take advantage and grow their market share. But now those margins have been collapsing, or I would say narrowing. So now it's like, everyone's in the 80 to 90 range. So the incremental difference between Travelers, Allstate, Nationwide is not as much as it used to be. So every company is looking for an edge. And I know Parker is working with a company that he's leading around now that is giving that edge in a number of lines of business. So I think that area is really strong. So that also leaves what's not hot, So, I mean, in everything, there's kind of a seesaw or teeter-totter, right? And sharing economy, I think in early days of InsurTech was a hot area with the rise of Uber and DoorDash and all of the sharing economy companies like Airbnb. And there are definitely some strong players in that space. But I would say from an interest of a carrier perspective, carriers have been shying away from it. Some of them actually shut down their sharing economy divisions. And I would say it's not as hot as it used to be. And it may also be because, the buyers, the sharing economy companies are struggling as well. And then the other area that I think 2017, 2018 was really hot, like, the last Bitcoin run up, was blockchain technologies. Number of insurers had bought big amounts of Bitcoin or other cryptocurrencies. They set aside divisions. It was very popular. In Europe, there's actually an association called B3I that formed. It's since declared bankruptcy. So that's definitely a trend that I think, as Parker kind of views it, there's definitely opportunity there, but it's for leading edge people that can really suss out what's good and bad. but most of the carriers are not really excited about it as much as they used to be.
Thank you, David. Yeah, a couple of follow-up comments on the sharing economy. I agree with your point, David, but that's a good example of an area where we had to get legislative change to fit insurance into that business model when it was brand new, because we all have our personal auto insurance policies, and then you've got these, sharing Uber and Lyft and whatnot that aren't really taxis, but we want to make sure the protection is there. So there were laws that were developed to facilitate insurance products for that area, which gets kind of hybrid in some respects. On the blockchain thing, I'm kind of a blockchain guy. There are several consortiums. One went into bankruptcy. Right before this call, David, I was on a Risk Streams call, which is another.
Oh yeah, I think Riskstream is definitely the strong one. They kind of pulled out as the leaders these days.
Yeah, but that is very much in an infantile state. 10 years from now, we'll really see where blockchain can take us, not just in the insurance area, but more broadly. Well, that's great, guys. Let's move on. So here we've just got some sample companies. There are many, many, many InsurTech companies out there, US and abroad. We just thought we'd highlight a few that some of us are familiar with, broken down by line of business. Policy Genius, I work with them. It's essentially an online life insurance marketplace trying to improve distribution for life insurance. They've raised lots of money. Ladder is on demand. We didn't really put that in the slide before this, but on demand insurance products, get it when you need it, right? That's a fairly new business model developed by InsurTech. Oscar is a big client of our firm that's in the health insurance space. David, I think Healthy might be one of your companies.
Yeah, Healthy was one of the winners of our competition. So one of the things they help with is, the bane of most people's existence, which is, you want to schedule a doctor's appointment and knowing the availability of all of the doctors that you might need, whether it's just a regular checkup or some type of procedure. So they're helping to automate that process. And as you mentioned, Brian, it could be offered as an employee benefit. And they're notable for having one of the largest seed rounds of an InsurTech recently. They raised $33 million in their seed round. So I think they are proof that money can still be raised in InsurTech. I mean, it was a little bit ago, but definitely a notable company.
Yeah. And then on the property casualty side, Lemonade, had a big kind of IPO splash a couple of years ago. Slice is a company I work with that started out in the home sharing economy and auto sharing. They have pivoted, to your point earlier, David. They're now in the SMB space primarily because of the shift in the demand for the sharing economy insurance. And Metro Mile, another SPAC IPO type of company in the private passenger usage-based auto space. And then David, I think you might know these reinsurance companies or a little bit about them.
Yeah, so Steer is actually one of our portfolio companies. So they focus on solving one of the challenges for MGAs, which is ultimately if you don't have long-standing relationships like someone like Parker with the underwriters, you need to get connected with them. So when you're developing a product, you need to have risk capacity behind you, and Steer helps with that process of building the actual document, the submission, and getting you introduced to the right underwriters. InsurTechs is similar. It's more algorithmic based and focused in the Lloyd's marketplace, but they're two examples of companies reducing the friction between companies that are looking for insurance risk capacity and insurance carriers or reinsurers that are offering it.
And maybe to clarify for the non-insurance buffs out there, an MGA, that stands for Managing General Agent. And that's kind of an outsourcing model where if I'm an MGA, I'm essentially an insurance producer on steroids. I might develop the product, the insurance product. I go find a carrier. So I'm kind of renting their paper, if you will. I bring the distribution. I do the claims. I just don't take the risk. And a lot of, or not a lot, but many of InsurTechs that started out as MGAs are now morphing into becoming risk takers. I've helped 3 in the last 18 months by what we call a shell insurance company that's got licenses. They capitalize it so that they're moving up the supply chain, if you will, and becoming risk takers as they improve their business model. Parker, you have any companies that may not be on here that you might want to reference?
Oh, like you said, there's just a ton of these that are out. I mean, it's just are we into the multiple thousands now, David? I would say of
Yeah, probably around
they're not all
3,000.
exemplary, but
True.
and I'm not sure all these are either necessarily always, but they're well-known names and brands that are might be familiar to some of the participants today. So, and shockingly, I mean, the space continues to produce new ideas, new founders, new startups. Our Zoom line's always chock full of people with an idea, with various forms of experience with technology or with insurance, or hopefully maybe both. If I had to choose, I'm not sure which one it would be, but yeah, it seems to be like I said, I'm long on the space of InsurTech startups, so I dare not start trying to create a list on the fly. Somebody will get upset, most definitely.
Exactly.
So
All right, we'll keep trucking then. So the markets are not just in the United States, certain parts of Asia. David, I think you mentioned somebody earlier from Asian area. Canada has a fairly robust, of course, a lot of those companies are doing business here. Western Europe, London, obviously, Ireland, Spain, Germany, some of which are traditional insurance markets. And I'm seeing a lot coming out of Australia as well. Parker and David, do you look at companies outside the US?
Yeah, most definitely. Like I said, I'm in the Middle East. I was in Israel last week, and I would add, interestingly enough, that while these are probably the key markets here, I do take a number of calls out of South America. I do take some calls out of Africa. I take a number of calls out of the Middle East. I mean, it really does seem to be a global effort today. But I think you've got it listed right here that this is definitely key. I don't know if David sees those continents or not, but I would take an investment from anywhere. I would like to see the US, be in the path of development, either as a market to serve or a place to be at some point, but mostly because I think it's the greatest opportunity. So I do want to see it come here eventually.
Yeah, so I mean, for our accelerator and competition, we're probably about 60% North America and then 40% the rest of the world, with obviously concentrations in many of the places that Brian has listed. But to Parker's point, like there definitely are some interesting companies emerging out of Africa, like the kind of India subcontinent. We had someone who came to our InsurTech Rapids conference, and they were focused in Pakistan, serving specifically the Sharia market. So many of you that are familiar know that how they do banking and kind of address interest and fees is much different than the US. And obviously where Parker is now has a lot of exposure to that. So that's always an interesting thing, seeing concepts out of there. I think a really popular thing is companies out of Singapore coming to Europe and the US. So we've had a few companies in the kind of life and financial services space come to our accelerator from Singapore. And I think one thing that's kind of interesting about the Asia market is I would actually say it's kind of like two different speeds of development, right? So you have the more developed markets like Japan and Korea that have, a few large insurance carriers that make up almost all of the market. And in fact, they have more, I would say, concentration or distribution of insured customers than the US because everyone buys life insurance there. So, and obviously they're much better protected versus, you have places like Vietnam that have less than 5% of their population have insurance for even basic things as like their automobile. So it's interesting to think about that market, but we definitely get exposure globally.
Right. Okay, so moving on, this is a very short list. Like InsurTech companies, there are many, many investors. funds and PE firms in the InsurTech space. These are just a few ones that I know or work with. The Broker Tech Ventures is an interesting group. I mean, that's where a bunch of insurance brokers got together, medium-sized primarily, and created their own fund, right? They didn't want to be on the sidelines with the regular investment community, nor with the insurance company investment community. Techstars, plug and play. Most people probably are familiar with them, so they do some stuff here. Hudson is a company I work with, and they've invested a lot in the InsurTech space and insurance companies as well, and have a nice portfolio of companies. So the insurance companies themselves also have internal VC arms that not only invest in InsurTechs, other types of investments as well, but a lot of these were kind of spurred by the InsurTech movement back in 2015, David, whenever we think this thing started. But, you know, big name companies, Aflac, Allianz, American Family out of Wisconsin, Assurant, which is based here in Atlanta, Liberty Mutual, Lloyd's itself, Mass Mutual, you can see the names up there. These are all internal VC arms of insurance companies across all lines of business, at least life and property casualty, maybe not so much health on this list. Any comments from you guys on that? David, have you worked with any of these, like RGX or any of those guys?
Pretty much all of them have either come to our events or our accelerator demo day. I think some are less active than others. So we did a survey a while back on corporate venture capital units, and I believe we did this in partnership with a university in the Netherlands. And from our data, I think there were about 80, between 80 and 85, we'll call it insurance companies that have made venture style investments. Some of them do it off the balance sheet because ultimately, in some sense, they are investors because they have to invest their money just like banks do. But other ones, like the ones that Brian has listed, have dedicated arms where they've set aside a fixed amount of capital and they're investing that. And what's interesting is a lot of companies that you would never necessarily think would have these investment arms do. So most people probably know, AAA, and they might have a AAA membership. AAA has an insurance company called CSAA, and CSAA has a venture group called Avanta Ventures that's based in Silicon Valley. And so most of these companies are trying to dip their toes in, and even if they're not directly, they might be investing in kind of consortiums like you have Manchester Story listed.
Yeah, Parker, any comments from you?
Yeah, I'd say there's, every time I think I've mapped and followed and met and hung out with every one of these venture sources, it seems like there's a whole nother slide maybe that would fit in the non-corporate slide. And some corporates that I'm like, I've never even heard of your insurance company, let alone known that you were out venturing in the space. And you're right, to some degree or another, there's some that are active, there's some that are maybe using it as an source of information or a partnership track or an acquisition track. But it's a robust space. There's a number of people, as in all venture, kind of exploded in the near-term history, midterm history. InsurTech is no different than the rest of that. So it's a big, robust space, in my opinion. And it's fun to have gotten to know all the people through the years.
I recently had
a lot of enthusiasm.
I recently closed a transaction that can kind of pull this all together. So one of the companies up here, I won't name which one, is an insurance company, has the corporate VC arm. My client is an InsurTech that specializes, David, you know who they are, in wildfire.
Oh, yeah, I definitely know. You don't have to go much more than that to say.
Yeah. So they specialize in with fancy algorithm and underwriting wildfire risk in California. So we did a deal with one of the insurance companies that's affiliated with one of these corporate ventures up here, and it's their paper. So our client is selling and producing and underwriting the risk. The insurance company issues its policy. the corporate venture arm of that insurance company invested into a captive reinsurance company in Bermuda, along with another private equity firm. And our client had a piece of that. So it was kind of an end-to-end InsurTech and an investment transaction, but also an operational transaction to execute the strategy. It was pretty fun to work on.
Yeah, well, and I think what's really amazing about that company is they're out there doing their work, and they demonstratively, from their kind of performance, have done better than some of the largest insurance carriers in terms of being able to determine where in the world wildfires are going to happen, but specifically in California where they're writing business.
Yep.
It's a cool company.
Okay, so I'm going to kick this over to you finance guys, just for some commentary on fundraising that's occurred. This is a slide we pulled from PitchBook, which I think is a pretty good summary of what's happened. You can kind of see the ramp up. And David, I think you and I first met in either 2017 or 2018, right when this thing was popping.
Yeah.
Kind of level funding growth from 2017, but fairly level through 2020, then the spike, and now we're back to where we were last year with 2020. But I'll let you guys comment on what you're seeing out there in the history that you've observed.
Yeah, so I think this is one cut of it, but another cut that I saw this morning, Empire Startups puts out a fintech newsletter. I think it's weekly. And what they compared over the last 3 or 4 years was what percentage of all fintech investment is InsurTech, kind of defining InsurTech as a subset of all financial services, VC investment. And last year, that spike was definitely in it. I think it was around 13%. This year, it's at 11%. So I think all of fintech has come down somewhat in 2022 compared to 2021. But as a representative percentage, I mean, it's still a really solid component and staying stable. So I think one thing that I feel about insurance is it's going to be consistently invested in for the next 5 to 10 years, because there's so much that this industry needs to fix, improve, and just opportunities that are out there, I would say, are even low-hanging fruit still.
Parker?
Yeah, I totally agree. And I think that when we get to that 5-10 year mark of like the most obvious things that need to happen amongst all the thousands of insurance companies that exist and distribution companies, there's going to be more things that we've thought of at that point that are going to, kick it along another 10 or 15 years. Like I said, the space has been innovating for 400 or 2,000 years. And I don't think that the pace of innovation will slow now that, the use of technology and digitalization has, found it. I take this as really positive numbers all the way. I mean, I think the space is extremely viable. I think the number of insured, if you look at the trajectory, 2021 was definitely huge for everybody in all spaces and all venture. And I would say things maybe got a little wacky there. But if you look at 2022 compared to the other years, it's still an up year. So, and I think that the number of InsurTechs in that time it's an up year. So, I think a lot of people sat around in 2022 wondering, what in the world's going on? And I just think that what in the world was going on last year? It's not 2022, it's 2021. Where I think people went a little nuts and kind of lost their minds at times. But I mean, there's been if you compare this to many markets, there's, been a bit of a pullback based upon the high of 21. But, I think this is capitalism. People want to start companies and have influence and create good and be successful. And I don't think people get less hungry. I think people get more hungry and more aggressive. And I just think that, it's a market. There's an ebb and a flow. But I wouldn't necessarily call this down. I would say it's down from 21, but 21 was really way up there. And I think if you look at it proportionally in valuations, that it'd even be a little more bit of a level, not level, but there'd be more of a leveling going on. So it was peak.
Maybe one
in my
thing
opinion
to add to kind of Parker's vantage point is that, these last 2 years or so is the first, I would say, end of the first cycle. So in other words, the companies that had started in 2013, 2014, 2015 have had exits. And now those founders are on company 2 or fund 1, like Parker's case. And that's a really interesting place to be, where you have people who have gone through a full cycle that can be mentors, advisors, or investors in the next generation. And that's one of the things that I get the most excited about, is to see that cross-pollination between people who have done it once and the people starting for the first time.
Right.
I think that's a great point. You're getting second gen InsurTech founders. And I think it's happening where they haven't even necessarily even exited the first company. They've just found that they're more entrepreneurial and they want to be a part of the earlier stage companies. And they found more of a, like operations manager, somebody who's maybe a little bit more technical versus the early stage enthusiast that's there. And it's not necessarily because their company's not going well. They just realize that they're more skilled in the earlier stage companies. And I admire that too. You see examples of that all throughout corporate America and at all various sizes and stages of companies. So, I think it's all very encouraging. It'll be interesting to see what happens in 2023. 2022 is a little bit of a new environment compared to 2021. 2023 is a new environment. Last week to this week is a new environment. So, I think there are some sleepless nights and we'll see how it all goes. But I mean, it's an ebb and a flow. And I think it's a fabulous industry, and InsurTech makes it an even better and better industry that is insurance. And so Brian, you've said it before, but the train's left the station, and I just think that people don't go backwards.
Yeah, one of the benchmarks for me is when the InsurTech client calls me and says, "You're a great lawyer. We're kind of done paying those fees every day. I need an in-house lawyer," right? So, of course, I help them find that. But when the company is maturing, where they need their own general counsel, that tells me that the company's doing pretty well.
Yeah, no, I remember for one of our accelerator education days, we had a startup come in the kind of embedded space Boost, and they were saying, we're at the point where we have multiple in-house counsels to be able to help our business run.
Yeah. Well, Parker, I think you were alluding to the elephant in the United States earlier, so let's hit it head on. So some of these, not many, I don't think, but some of these InsurTech companies have some exposure to Silicon Valley Bank because they have deposits there, or perhaps they've got some borrowings from there. You guys want to comment on that?
I'd say more than a few. I'd say there were a lot, personally. I don't know exactly, but I would say that, what is it? Nearly half of all venture-backed companies and VCs are, banking or were banking with Silicon Valley Bank. And, I don't think that InsurTech was any different than the rest of the world. Personally, David would know better than I, but I mean, it was a significant amount. And so, yeah, I think it was a wake-up call. I think that of all the these are people dealing with risk every day, and they're very dynamic, venture capital backed startups. And I think of all the things that they need to worry about with the risk and their startups, et cetera, the last thing that they felt like they probably need to worry about in these early stages was like, my deposits are also at risk here. I mean, in some of these cases, people had tens of millions, if not more. In some cases, depending upon how you include them, billions of dollars of deposits at Silicon Valley Bank. And so they were on the line. I think there's just no way around it. I no doubt, and I know personally, and might have myself, who had some exposure, probably had some like weak sleep nights, Thursday, Friday, Saturday, Sunday. So, I think it was a major wake up call. I assume that most are, I don't want to say out of the woods, but there were a lot of held up closings. There was probably some held up payroll. It's still probably a huge pain. But I think in a space that was always already a little banged up coming out of 21, 22, And all the things that you've seen written about Silicon Valley Bank that's what's also was happening inside InsurTechs. Deposits were probably trending down, probably less likely out raising because of valuations. And it was like a perfect storm or a bunch of dumb coincidence or compounding issues. But that was real, in my opinion. That was a moment in history.
Yeah, no, I think it was definitely a stressful weekend for a lot of InsurTechs. One of the people that's actually one of the companies that's in our office, they're more of a fintech, but they published a report on LinkedIn of like 170 companies that were affected because they kind of integrate with some of the accounting systems. And I can tell you one of the companies on the list was one of the few InsurTechs that was public that a lot of carriers have exposure to. So I think a lot of people are thinking, oh, this is just a seed stage, a Series A stage company thing, but this goes all the way up to the public InsurTechs, the ones that are, big names with tickers. So I think this caught a lot of people by surprise. I mean, it happened very quickly. It was basically over a 48-hour time period. And there's some founders I know like that, they just sent out emails proactively to their vendors to say, we were affected or we weren't affected. And I think until that announcement from Treasury came out, I think it was like midday on Sunday, a lot of people were really worried. And I think the more worrying part was actually the second order consequences, because a lot of people think, well, oh, I wasn't exposed, so I'm good. But, what payroll software are you using that was exposed, right? What CRM you're using that was exposed? What about core infrastructure technologies that might plug into your cloud that was exposed? So I'm thinking what happened behind, closed doors with the Treasury was a combination of three things. One is, a jobs report's going to come out in roughly a month. If we don't backstop these companies, it's going to be a real ugly jobs report. Second thing is, I don't think people understood at the beginning what this actually meant. They originally thought, oh, well, there's not going to be a lot of contagion because this is all, venture-backed companies all in Silicon Valley. They didn't realize that there was global exposure, like the UK group that affected, like, I think it was just as much, like half the UK venture-backed companies, the India division of it, which is still not fully resolved. And this was also a confidence thing, right? Because if one single action of a regional bank can take out, half of the startups, then what other banks are safe and not safe? And if you dig into, their balance sheets, a lot of them are not necessarily the greatest. I mean, I have a community bank that I use, and first thing I did on Saturday was, pull up their balance sheet. And fortunately, they had no securities that were kind of held to market. So I felt good about that. But that being said, like the difference between a bank run and not a bank run is literally just a few people making comments online, which is a kind of frightening thing.
Yeah, it shows you how, of course, this was very flukish and like a very connected, already kind of banged up community backed by influencers, the capitalists. And it went extremely fast, but I think it's a good lesson for every startup and every institution and every professional out working, how important confidence is on anybody's balance sheet and how fragile that really can be. And so I think it was a wake-up call for everybody, so that they understand, like, hey, this goes, like, confidence goes quickly. And whether it was, there'll be a lot of finger pointing and Monday morning quarterbacking on this for a long time and a lot of, opinions. But I don't think anybody expected or wanted this to go as poorly as it did. And it went so quickly. And so I think it feels like there's a sigh of relief in a lot of these communities. And I think, to David's point, like, nobody really got to see how bad this was going to get because of the backstop of deposit insurance and help with the treasury. So
Yeah, I think maybe on that point, Parker, I mean, insurance saved the day for everyone. If the FDIC didn't exist, we would be all in trouble. So I think
this be toast. Yeah.
a lot of people, don't, going back to my original comment that, we started this because a lot of people in fintech thought InsurTech is the ugly duckling, yet, in arguably the biggest crisis this year, I mean, maybe you can debate over the drone shot over the weekend, but arguably the biggest crisis year was averted by an insurance product that was created to backstop people and the support of the government aligning with it.
Yep. Great.
Well
All
said.
right. Let's keep moving. You mentioned public companies, so that's a good segue, David, into this slide. So these are just a number of companies that had big deals in their day not too long ago, several IPOs. I mentioned Lemonade. Lemonade has since merged with Metro Mile. I think that was, last year. The Prudential acquisition of Assurance IQ was kind of off the charts in terms of valuation. And, my intel on that is that hasn't worked out so well for Prudential. I don't know if you have any inside intel on that, David.
I think that's right. Yeah.
Yeah. Well, I think it worked out in terms
It's well
of
reported. Yeah.
It just was the value created that they paid still questionable.
Yeah. But these are all fairly big deals, right? Based on valuation and amounts, right? So we, what do you call it, David? What do you call the InsurTech? What'd you say earlier?
Oh, Eusticorns.
Yes. Yeah. Sometimes the insurance industry is perceived as the redheaded stepchild of, no offense to redheads, of the financial. So I've always viewed insurance as part of financial services in the broader sense, probably not our listeners here. But the reality is that insurance is a cornerstone of any functioning economy because you fintechs and banks aren't going to lend money unless there's insurance, right? Okay, so then just to get a little bit of my world in here, from a regulatory compliance perspective, these are a number of issues that some of which are not new or old wine in new bottles, so to speak, but frequent issues we see with InsurTech. So in insurance commission sharing, for example, there are restrictions on the ability of an insurance company or licensed insurance producer to do rev shares, right, with non-licensed parties. We've got ways to navigate around that. We also have anti-inducement and rebate laws that basically say you can't give somebody something of value to induce them to buy insurance. And that comes up a lot with distribution partnerships as well. The alternative data and artificial underwriting is a big deal with the insurance regulators. They want to understand what's in the black box. They're afraid of the boogeyman and, unfair discrimination that could result from a flaw in the data or in the operation of the AI. So we're seeing developments, and eventually we'll probably, I'm not aware of any like what I would call an artificial intelligence law yet in the United States, but the insurance regulators have put out guiding principles. And part of the problem or challenge with the insurance departments in the AI area is they don't have the staff to really do this stuff, right? Because the InsurTech companies, the insurance companies are hiring the smart young kids, right, with the AI data science background. And so there's got to be some development in the workforce for the insurance department so that they can, unless they want to outsource it, so they can effectively understand the technology, but still do their job, which is twofold in the insurance area. Regulators, number one, are protect consumers, and number two, protect against insolvencies of insurance companies. It's that simple. And the AI area dovetails with privacy and data security, which is a huge ongoing development in the law in this country. Maybe someday we'll have a national standard, but I still see that as a way off. Any of you guys got any comments on that? More in my area.
Yeah. So couple things, Brian. I would say your kind of top left of the honeycomb, the inducements and rebates. I think on its surface, it seems like, oh, well, I know that makes a lot of sense. Like we can't just, give policyholders money back to sign up, like you might do with some of those e-commerce apps. But it goes much deeper than that. And I think earlier you talked about that example with John Hancock and Vitality. So things that logically make sense, right? If we help people become healthier, we should be able to give them discounts on their policy. And I think a lot of people don't realize that is a sensitive issue. Some states make it really difficult. You might have to actually file specifically and get approval for that. So a lot of founders don't realize what they're wading into for something that sounds on the surface like you said, Brian, that it meets both of the requirements. It keeps stability of the market and it protects consumers actually better. Laws are not necessarily in place to support that. And then I think the other hot button issue that we've seen a lot or heard a lot of chatter around is, this kind of classification and discrimination. There's some states that have talked about, they want to eliminate the use of credit score, which, just like for banks, credit score is pretty fundamental for underwriting for insurers.
Well, those are two excellent points on the inducement and rebates. The regulators get that there should be exceptions for things that are provided to policyholders that help reduce and identify risk. So, for example, a homeowner's insurance company might want to give away a detection device that monitors water in the home, right? That's good for everybody. And last year, the regulators went into, this law is embedded in the, no pun intended, in the Unfair Trade Practices Act. They hadn't touched that law in 50 years. But consensus was that we should go in there and modify the law to allow devices and other risk monitoring and mitigant devices that would otherwise have been a rebate, because it does, to your point, David, helps everybody. So we are seeing change in that area, which is good. Okay, we're going to round out here in a second. So we thought it'd be helpful for you to understand there are some regulatory sandboxes, as I'm sure there are in the fintech area, in a few states. But to be honest with you, David, Parker, chime in. I don't know of any company that has actually entered any of these insurance regulatory sandboxes. They're there.
It's a good point. I think we sent a company over to the Bermuda sandbox. They were one of our competition finalists, but none of those 3 or 6 states you have there.
Yeah.
So I have to remind myself that it exists. Yeah. People just go for it.
Good idea. Yeah, exactly. It's a good idea, but long process. And again, you've got regulators, with all due respect to them, I work with them every day, that don't really understand a lot of this stuff.
Yeah.
And then finally, and I'm sorry I haven't been able to watch the chat here. I'll check it in a second. These are just other areas or entities where you could learn more about InsurTech, including David's group in New York. There are analogs to his group, and well, you've got San Francisco covered too, David. There's one in Texas, Hartford, the Global Insurance Accelerator. I'm on their mentor board and worked with that. That's a big one out in Des Moines. Des Moines is the new insurance capital of the United States. It's not Hartford anymore. And Lloyd's, of course, has one. So a lot of accelerator, incubator, or conferences such as On-Ramp and Dig In that you can meet a lot of InsurTech founders and folks that support that community. So I think that's really what we wanted to cover. Joey, if you're going to get back on, and I'll try to find the chat here.
Yeah. Unfortunately, we are right up against the hour, so I need to wrap things up. And I would like to thank all of you for a really informative, and obviously we could keep talking about this for quite a while. But thank you all for a great and a very informative discussion today. And thanks to everyone who joined us. As a reminder, the recording of today's session will be available soon on the NFO's YouTube channel. And be sure to join us for the next presentation, Growth Garage. Details and registration will be available soon on the NFO website at nationalfintech.org. With that, I would like to thank you all again for joining us. Have a great day.